This is Matt Restuccia, the Chief Investment Officer at Argent Wealth Management, and this is the June-July 2024 market view. At Argent, our differentiation is our deep knowledge and practice of tax, estate planning, and investments under one roof. You can connect with us on various social media, Instagram, LinkedIn, Facebook, X, and YouTube, where this will be uploaded. So let's start with the conclusion. And what happened since the last market view? Well, the S&P 500 went down over 5% in April from its all-time high. Sentiment got briefly pessimistic, then recovered along with the S&P 500, which reached new highs in May. That 5 to 10% correction and recovery to new highs is very typical in a bull market and is a good sign. Inflation is on a downward trajectory. We saw that in some of the PCE data that came out last week, but it's likely to remain stickier than expected. And we've been saying this in the last couple market views, and this is due to a strong economy. So with low odds of recession, because of the strong economy, which is keeping inflation high, the bull market is likely to continue. The main risk that is not a recession, I think it's actually reinflation, which could force the Fed to raise rates more than they're currently at. I've put low odds on that, maybe in the 10 to 15% range, but it's potential risk. In that scenario, you might get a correction over 10%, although unlikely a bear market, and a recession clearly wouldn't happen if you're getting reinflation because of a strong economy. But this risk's overhang could keep markets volatile in the coming months. So let's talk about corrections and the history of corrections. So it's only been 23 days now since the S&P corrected 5%, more than 5%. It's been about 142 days since the S&P corrected 10% or more. But in long-term bull markets, which we've been in since 2009, you can see in this green shaded area, that's the long-term bull market we're in. The market average is 331 market days without a 10% or more correction. So that's about 50 days more than a year. It's about 250 trading days in a year. So we're not there yet. There could be plenty of time before we see that type of correction. Of course, it could happen before then, but certainly we're well within the average time period. And we talked about sentiment in the conclusion. A 5 to 10% correction with sentiment going pessimistic that quickly is typically the sign that we're in a bull market. People got pessimistic very quickly, but then it recovered very quickly. Presidential cycle. So we've been talking about this in our last few market views. The chart shows that typically in an election year, the S&P bottoms in May. Well, we had a very similar situation this year. So there is alignment between the 4-year cycle and market behavior noted on the previous slide. And recession odds are low. This is a Ned Davis chart that takes the leading indicators, indicators that tend to forecast the future of the economy from 35 OECD countries, shows that the odds of recession are very low at this time, under 15%, and that trend is moving down towards zero, and when that happens, typically it's very strong for markets. And the economy remains strong again. There are 1.3 times the number of job openings per unemployed in the United States. So companies are looking to retain and hire new employees as they invest and grow. And as we've been saying in the last few market views, with consumption at 70% of GDP, you have a consumer who's in very good shape with a debt service ratio below the average and well below levels you see typically leading up to a recession, as you can see kind of pre-2008, and in the mid-80s, and even pre-2001, you had much higher levels. And credit conditions. So you have a consumer who has a strong balance sheet, and you have credit conditions which are strong, and the trend is moving in the right directions. They're favorable. So you have businesses, you have consumers who are in good shape. If they want a loan to help fix their home, build an addition, grow their business, whatever it may be, credit is available. And if credit's available, and you have strong balance sheets, it's tough to see a recession. Again, this is why I think reinflation is actually the bigger risk here. And then, you can see inflation is on a downward trajectory, but you can see it more recently just staying sticky, not coming down as it initially did, not as fast. And that's typical, I think. Coming down from a 9% level to a 3 to 4% level is much easier than getting from kind of that 3 to 4% level all the way down to 2%, which is what the Fed says they want. But certainly inflation in the 2 to 3% range, I think, would make investors pretty happy. So that stickier than expected inflation has decreased how much investors expect the Fed to lower rates this year. And I think that's the consensus reason the stock market had that kind of 5 to 10% correction. Higher for longer rates increases the hurdle rate to invest in projects or homes. So the economy, I guess, well, the idea is that it helps slow the economy. But why did the market recover? Well, one possible explanation is that investors are kind of in a win-win. Not to be overly optimistic, but a strong economy may keep inflation elevated, but that means, again, a recession is unlikely, the theme of this market view. And if the odds of a recession increase, it will likely be due to consumption falling faster than expected from consumers. And in that case, the Fed has plenty of room to lower rates, and they'll lower faster than is currently priced in, and that should support the stock and bond market. So the Fed, in hindsight, although they were late to increase rates as fast as they did, they've put themselves in a strong position, and therefore investors are in a pretty good position as well. And if you look at the history of bull markets, again, we're in that long-term bull market, as you saw in the previous slide. Typically in these types of markets, you get about 105% cumulative return over 751 days. This chart shows that the Dow Jones, just over 400 days in, has gained like 39%. So again, well within the averages. And if the bull market lasted for another year or two, that would still be within a normal distribution of a bull market within a long-term bull market. So would not be surprised if we see that. Investors generally worry about the election with good reason. Policies of different presidents can affect different areas of the market, but overall, from a very high level, pessimism about the president has actually been better for the markets. The markets have done better when there's pessimism than when there's optimism. And I think that's because typically if there's a lot of optimism about the president, a lot of good news is already priced in. People are feeling really good. Markets are at highs already. There's probably overvaluation. The economy looks really strong. There's not much better you can get if you have a lot of positive things to say about the president. It's probably because the economy and the market's done really well. And you see in this chart that excessive pessimism is not good about the president. So kind of this tweener pessimism range is fine, but if you have excessive pessimism, that's not good, but that's because it usually aligns with a major recession. So really this poll is telling you, as long as there isn't a major recession, the general view about the president isn't bad for the market. It's not going to push the market around. It's ultimately what's going on in the economy. And that's important for investors to remember as we get into this election this year. So Argent Wealth Management, we have multiple investment strategies. We are open architecture, providing solutions for our clients. So please contact us if you're interested in how we can provide solutions for you.